Okay, welcome everybody to episode 53 of the Volatility Barometer. Sorry, I was a little late hitting play there. I forgot my coffee. Oh, what's going on? Pause YouTube. Shut that up. Yeah, I forgot my coffee, and as you know, it's completely impossible to do a live stream without coffee, especially since, for whatever reason, I seem to always go running on the same day as live streams. I even talked about it last week. I said I would try not to do that, so I'm not as tired. And yesterday, I was writing, I was kind of in the zone. It's time to go running, and I just decided not to. So figured I would skip the workout yesterday. Skipping one workout is fine, but skipping 2 days in a row is a habit, so I would not do that ever 2 days in a row. So I went running again, but got my coffee. Hopefully you've got one too. We've got quite a few good questions today, so I think it's, especially if you're following the VTS community, I think today is going to be a good one because we do have some Iron Condor stuff to go over, volatility trend strategy, which is always fun for me, talk about UVXY and shorting VXX and all that stuff. So some good questions today. And of course, we will go over that Twitter poll that I put up last week. I thought that was pretty interesting. I know it's a TikTok trend and those things are sort of a little bit meaningless, but I think there is a few important points to go over with the, would you rather have $2 million today, right now, or would you rather have $4,000 a week for the rest of your life? So we'll go over that as well. As always, live streams, don't super chat, don't send me any money. Everything I do is free. It's just to help everybody out. But if you would be so kind, the cost of the live stream is a like. And also, we are pushing fairly close to 25,000 subscribers now on YouTube. So if you are not subscribed, that would be a big favor to me, not only to subscribe to the channel, but also to share this with other people, anybody you think might have interest in seeing it. We talk about a lot of investing subjects, and of course, it's not always easy to get your questions answered. We do sit in front of the live stream for, at least an hour or two a week. So please forward this to anybody you think might be interested. But let's get started. Okay, so I think I'm going to try to mix things up a little bit today. I think what we've been doing the last few weeks, I have answered all the submitted questions in a row, and then I can babble on. Everybody knows I can talk a lot. And so there typically is, we frantically try to fill in the live chat at the end. I think what I'm going to do today is try to be a little bit disciplined. I know you've heard me say that before, but today I'm really going to do it. I'm going to answer 3 or 4 questions of the submitted, and then I'm going to hop over to the live chat, do a little bit of that, and then we're going to try to do it in 3 different places today instead of all at once. So let's get into this. So first of all, hopefully you can see this. We're on the screen share. As always, if you are not aware, every week in the community tab of my website, my YouTube channel, in the community tab, I will submit this and you can just fill in your questions. So you'll have 3 or 4 days. If you think of something, I will answer it for you in the live stream. So today we've got 12. Some of them might take a few minutes. Some of them, hopefully I can breeze through pretty quickly. So first one, let's get right into this. I have seen that you deploy more than one Iron Condor calendar trade at a time. Could you explain the rationale behind how you layer the second trade? So yes, this is our daily email from today. And it is true, if I scroll down here to the Iron Condor strategy, we do have an availability for 3 trades at once. Right now, we only have 1. It's just kind of the way it's worked out. Probably on Monday or Tuesday, we're going to open a new one. But yes, we can do 3 trades. And essentially, the reason that we do this, let me go back to which screen, default screen. There's a couple reasons why we do this. So I would say the first reason, of course, diversification. Now, if you have one Iron Condor open, the trade structure itself, it's not a strategy, it's just a trade structure. But an Iron Condor throws out a pretty wide net. It covers a nice range on the underlying security. So there's nothing wrong with one Iron Condor. You could do that to where you put a small portion of your portfolio towards a delta neutral strategy like Iron Condors, and you just throw out one, kind of manage it. We use stop losses. I'll get into that later. But that's fine. There's nothing wrong with that. But to add diversification, you can add 2 or 3 different layers. And what you'd really want to do, you don't just want to throw 3 very close to each other, because then you're basically double and tripling up on the same trade, right? So you'd want to vary things across price. So for example, the SPY, I can actually show you our current trade. It's probably, after today's market ugliness, getting quite close to where I would consider throwing out a second layer. What is SPU? That's not even a thing. SPY. So this is our trade, and right there at that hash line is the price. So right now we're basically break even with this trade, and we opened it when it was right there in the center. So what you don't want to do is just open a bunch of trades where they're basically just double of the same thing. But since the price has moved significantly, the first variance is across price. I could open one if the price was here, another one if it gets over here, and now I have 2 trades that are centered around different prices, and that's going to make it more diversified. The other thing that you can do, of course, to make it even more diversified, you don't just open the same trade on the same expiration. Right now we're doing this 56-day, but the next trade I open will probably be on the May cycle. So now I have diversified again across a different expiration cycle, different time frame. The other thing that you would want to look at, of course, the VIX index kind of sucks, but everybody knows what it is, so we use it a lot, at least to show people. I don't use it in my trading. But you could also vary it across different volatility levels. So maybe you opened one Iron Condor when volatility was pretty low, and then you opened another one when it was higher. Now you varied it across volatility. And then, of course, the fourth layer you could add is different asset classes. So maybe you've got 1 or 2 on the SPY, and then you could throw out one on the TLT for the 20-year Treasury. You could do things like that. And now I've got Iron Condors that are spread out across price, time, different expirations, different volatility levels, and different asset classes. So then you get to this situation where you've got the potential for a diversified portfolio of options that is already inside a diversified portfolio in total. So the Iron Condor strategy is 20% of our portfolio right now. And if I can do my job and make sure that it's diversified across those 4 variables, then this is also going to be very diversified. And it is going to be better long term. So that is a fairly long-winded answer, but basically it's for diversification purposes. All right, number 2, we'll keep going. I said 3 or 4, right? Okay, number 2. What factors go into deciding whether or not to break the wing on the vol trend butterfly? I've noticed that they've been mostly symmetrical lately. So again, another very good question. This is specific to our short volatility strategy, this one here, the volatility trend. We're essentially taking VXX or UVXY trades. We're trying to, not track it, but basically we understand that long term, these products do decay, right? As long as there's positive roll yield in the VIX Futures term structure, we are expecting these to more or less decay. Of course, you're going to have some losing trades along the way, but that's what this strategy is. But the question is, why would we do a butterfly versus a broken wing butterfly? So right now we do have a trade open. This is a live trade within our portfolio. Again, there's room for 2. We only have 1 open right now. I could probably do another one early next week, so stay tuned for that. But this is our trade. This hash line is the current price. So this is a butterfly. This is an equal, you can see 12, 11, 10 butterfly. The question is, well, why do we sometimes do broken wing butterfly? So I can set one of those up really quickly here and I can show you the difference. So what we could also do is a 12, 10, 11. So this is the same trade, right? Come on, cancel that. This is the same trade right there. But what we could do is we could break the wing. A broken wing butterfly is essentially one of the strikes is closer to the short strike that you're selling. So this one is a little bit further away because, of course, on the VXX, we are much more worried about volatility spiking higher than we are it raging lower. I mean, a couple times a year, maybe it will cross the whole thing and it will go over here. It's possible you can have a losing trade, but more or less it transfers some of the risk from over here and it puts it over here. So what would be the reason why sometimes we do this and sometimes we don't? Well, there's 2 reasons. Number 1, the VXX right now, the price is a little bit low. So the pricing right now, the option premium that we're bringing in, it is a little bit skewed. We're in a situation where the market has been going down considerably lately, and the premiums are not what they used to be. So our old broken wing butterflies, I can show you the live trading results here. You can see that for these butterflies, our last trade was for a 31-cent trade. I'm sorry, I was lazy. I didn't fill in the one we just recently did. But 31, 37, 35, you can see that, right? But watch what happens when I go closer. 22, 14, only 7 cents for this one. And this one's a broken wing, 11, 10, 8. See, this one is a 987. This is a normal butterfly. Broken wing, broken wing, broken wing. Well, why were we doing all of these broken wing butterflies for such low premium? Well, it's like I said, one of the reasons is the VXX is just really low and it's inefficient right now. The distance between one strike is actually on a relative scale pretty large. If this thing did a reverse split, then all of a sudden the broken wing butterflies would make more sense. And it really comes down to how much you pay for the furthest out put. So if you look right here, this trade, I hope you can see that. Hopefully it's big enough for you. You can see my position is a long, short, long for the 12, 11, 10. This 10 strike is between 0 and 3 cents. So it's basically nothing. The 950 is the same thing, and the 9 is pretty close as well. We're talking about a penny and a half. There's really no gap there. So if we do a broken wing butterfly, there's no advantage to taking it down to the 950 or the 9. I'm not saving any money there. But if the VXX did a reverse split and it went back up to 50, at that point, there would probably be a point where the further you push it out, the closer you get to 1 cent. Sometimes we're selling the furthest put option here. This is a 10 if it's a totally equidistant one. This 10, it might be 10 or 15 cents sometimes. And then in that respect, pushing it out to the 9 might only be a penny. And you can save yourself a significant premium there. So right now, mathematically, the difference between this butterfly, and we have 20 contracts open, the difference between this butterfly, you can see the maximum loss happens at $10 and I could lose $5.20. Well, this one, no, that's not right. This one, same thing. If I go out to 950, the maximum loss is still the $500 at 10, but it will push higher and I could actually lose a lot more. That's because the premium didn't change. If this thing did change, let's say I could have got it for 13 cents because I broke the wing and I saved a lot of money on that put, then maybe it would be advantageous to transfer that risk over. But right now, it just doesn't make sense. And same with the UVXY. At a price of 560, you're talking about strike gaps that are definitely 1 penny when you push it out. There's no advantage to doing the 4, the 350, the 3. These are all going to be bad strikes. So we also have not used the UVXY lately either. We're using the VXX. But hopefully that makes a difference. Hopefully that explains it, that really it's a function of the fact that the VXX has declined so much and also the price is so low, right? The premiums are all skewed. We used to really enjoy some of these. You can see even a credit of 2 cents. Some of these are, a credit of 20 cents. This is a 14, 13, 11 broken wing butterfly. We got 20-cent credit for that one. This one, 37-cent credit. And then what happens, of course, you can make a pretty big return if you get those big credits. Let's see, like 447 for one trade. That's actually pretty significant. How did I get that? Well, I got a credit of 33 cents on a net debit spread. That's actually a potential for a really nice gain. This trade recently, 31 cents, it probably made money, but it only made 1.14% because that premium is actually a debit of 31 cents. So it is all just a live open market. Everybody can trade the prices that they want. There's buyers and sellers, and sometimes it just aligns that way. Right now, there is no advantage to breaking those wings. You're just introducing more risk and you're not actually reducing any of it. So no reason. All right, let's do one more and then do the live chat. Okay, so you mentioned in a previous stream a strategy called the Wheel of Fun. Yes, sometimes I mention things that aren't currently offered in the portfolio, but at some point in the past, maybe they were. We've got a lot of strategies. We don't just have these 5. It's just that right now, given the market, this is the best portfolio that I think will perform the best. But we have had a few things in the past. So Wheel of Fun. Is this similar to the triple income option strategy? I read your question earlier today and I wanted to Google what that is. I'm actually not familiar with what that is. I can take a guess. I can probably say, yes, it's the same thing. It's just a different name for it. but I didn't actually Google to see who sort of coined that phrase. The Wheel of Fun is just something that I made up. You won't hear that anywhere else. That's just what I call my own strategy. I named it, back in 2006, I think, ages ago, and it just stuck with me. It sounds cool. I'll explain it in a second. I know you are preparing more detailed materials for your option strategies, but any teasers you could offer for this one? You know what? You just reminded me one thing really quickly. I didn't actually open the Iron Condor course, so I have to let you see my dumb face here while I actually put my password in. I don't want everybody going into changing my course and deleting all the lessons. So let's see. Bear with me. Just stare at me for another second or two. Once this course is open, I'll give you something better to look at. All right. All right. We're good to go. So the Wheel of Fun, essentially what it is there is a video for it in the past. It's currently, I think it's unlisted, right? This was over 5 years ago. So essentially what the Wheel of Fun is, and you can tell me if it's the same thing that you were explaining, but it's a very basic strategy. This is not, reinventing the wheel. There's nothing super exciting about this. It's just a very basic strategy. You start with selling a cash secured put on an underlying instrument that you think might be, undervalued. It's gone down significantly recently, and you can sell a put. You can collect some premium for that. And then there's going to be two potential things that could happen here. Let me just play this. There's going to be two options that could happen. It could either expire in the money, which means your shares are now assigned. So if you sold a put, let's say on Tesla, it's going down. One of two things can happen. Either it can go down below the strike price that you sold and you would be assigned Tesla shares. You would now be long Tesla. The second thing is it could expire worthless. If Tesla went down, stayed the same, went up, didn't cross that in the money point, then nothing happens. You keep your premium and you just rinse, repeat. You go through a little wheel right here. But now that we are assigned shares, you kind of just move on. And now with your shares, you sell a very aggressive covered call. The point here is not to capitalize on the Tesla shares. The point is to capitalize on the short put you sold and the covered calls you're going to sell. So you're going to get really aggressive, close to that strike price that you sold, because you want to dump your shares. You don't want to hold Tesla. That's not the point here. But it's possible that the covered call does not get assigned. And if that's the case, you just rotate the wheel. Every month, you can sell more premium on those Tesla shares. Hopefully, the addition of that premium over time will cancel out anything else that happens. And then you basically lose your shares and you rinse, repeat. So that's why we call it the Wheel of Fun, or that's why I call it the Wheel of Fun. You can see what's happening here is you're essentially going around this wheel. You sell a covered secured put, cash secured put always. Don't overexpose. Make sure you've calculated that if you do get assigned, it's not going to be a massive shock, because if you're selling short puts on Tesla, your broker will allow you to sell quite a few of those. And then if you get assigned, well, you could be holding a massive notional value of a position that you can't possibly sustain. So of course it has to be cash secured. That's very, very important. And then assigned, sell the covered call, try to dump the shares for a good premium, rinse, repeat. You go around the wheel. But it doesn't have to actually just be on the put side. You can also do this on the call side. You can sell a cash secured covered or a call to start the wheel. This would be if you thought something was very overvalued. You sell that call, two things can happen. It can either go in the money and you are assigned a short position in that underline. So now let's say Tesla, you shorted a call and it went actually past your strike price. Well, now you own a short position in Tesla. Well, then you sell a covered put and you try to get rid of your shares. You're going to do this at the top end. You're going to do this aggressively. Try to bring in as much premium as you can. And again, you can go around the wheel as long as you don't get assigned, as long as you don't lose your shares. But the goal here is to just go through this blue sequence. And again, it is a wheel. So you can see that. You can do this on both sides of the trade. So you can start the wheel when, let's say, the markets are showing a lot of weakness, like right now, for example. I would not have a huge problem with people starting to do some wheel trades. It's not the best spot in the world. And of course, I wouldn't use Tesla. We tend to use larger indexes like maybe XLU, something like that, XLE, something that's not going to have corporate earnings and real big surprises. You probably don't want to do Tesla. That was a terrible example. Ignore the fact that I said Tesla. Pretend that I said the XLU, the utilities ETF. But you can do that when it's undervalued. And then hopefully because you're aggressively trying to get rid of those shares, you're going to get rid of them. And then you're probably going to take some time off in the middle. Like as things are trending strongly upwards, you don't really want to be doing this because you can get shocked down. But once you start feeling like things are overvalued, now you can start working the call wheel. And you can bounce back and forth based on market valuation. It's not always perfect. You will have some failures. You will have some times when you're holding the shares a little bit longer than you anticipated. But overall, this is what my wheel of fun is. You're basically try to identify a stock, an ETF, an underlying index, get to know it really well, understand how it moves around, what those premiums typically pay so you know what's aggressive and what isn't, and then just work those wheels as much as you can. The last factor that I want to warn people, in case they're actually going to go do this on their own, is I actually employ what I call a 10% total value stop loss. So what that means is if I sell that cash secured put, a lot of people out there will tell you that, oh, it's fine. I'm going to make money doing something I would have done anyway. Like let's say I did want to hold the XLU, the utilities ETF. Well, I can just sell a put and I wanted to hold it anyway, so I might as well get paid for what I was going to do in the first place. That's the rationale people will hit you with. But the problem is when you sell a put, you're actually not reducing your downside risk. When you're selling covered calls, you're not reducing your risk. You're bringing in pennies in premium, but you're still on the hook for a pretty significant crash. So I deploy always a 10% total value stop loss. If the money that I have in this wheel ever dips below a 10% loss, you just, whatever stage you're in, you just shut it down and that's it. Don't ever allow yourself to lose more than 10% of your capital. Because of a successful wheel, you might make 4 or 5% in a couple of months. So you don't want to get into a situation where you do that a few times and it works out really well, and then you get hit with a massive 30% loss. You could lose 6 months, a year of your progress. So make sure you're deploying that capital stop loss, 10%, 5%, whatever it is. Don't try to do the wheel with no stops and just say, oh, I'll just hang on for the ride. You can't hang on because let's say you get XLU at a certain price and it goes down 30%. Well, now the premiums you're selling are going to be so little that it's not even worth selling them anymore. So don't put yourself in that position. Make sure you do have that stop loss. Okay, so should we do a couple of the chat? I answered 3 of those. Let's do a couple of these chat and then we'll get to the 2 million thing because I think a lot of people are interested in that. So this is the first one. Oh, first of all, let me get rid of all that stuff. Let's make it blank. Why do you think the S&P 500 will have less growth going forward? I think AI could improve productivity to a point where we can see the same performance within the next 10 years as the last 10. So what he's getting at is I've been pretty consistent with my opinion that I think investing is going to be more difficult going forward. I think that, a lot of people say, oh, the S&P 500, if you just buy and hold the S&P, it would have made X amount. So just so we're talking about the same thing, a lot of people will say that it's made 10%. I'm always pretty quick to point out that no, that's actually not that accurate. If we just do a straight up 25-year period, which is a reasonable investing time frame, let's go back to 1997, adjust for inflation, the S&P has returned 3.85, and if you invest your dividends along the way, 5.7. So a lot of people will say 10%. As I said, it's probably closer to 5, but I even think that's a little bit ambitious. I think going forward, the next 20 years won't be as good as the previous 20 years. The reason I say that is essentially that, I might be wrong, but one of the things that I do believe is that the markets are, I wouldn't say running on fumes. I wouldn't say that you'll see the doom and gloom is coming. I'm not one of those people, but I do think that the Fed, the government, the spending, the debt levels, all these emergency measures that are always put to the market, I do think it progressively makes the market a little bit less likely to continue performing well. Again, I'm not predicting some type of epic disaster. I just think that it's rational to think that whatever they were able to do in the previous 20 years with all the emergency measures and the helicopter money and all of that, it's a rational approach to say that it probably won't be quite as effective going forward. And when you've got a situation where you've got less and less people working for less and less productivity, but the debt is getting progressively higher, you got a situation where you're actually going the wrong way with that GDP thing. You actually want productivity to be going up, not down. We seem to be racing against something that, diminishing returns. We're always chasing that ever smaller pot of capital that we can build towards. So I just think it's rational to assume that. I also think it's rational to assume that the bond market probably won't return the same amount that it did in the previous 20 years. Of course, since 1980, interest rates were incredibly high. There's always an inverse relationship between bonds, right? And a bond fund. So as interest rates are coming down, bond funds will perform well. So since 1980, it's basically been a 37-ish year bull market in bonds. But interest rates, what they are today, and then the bond fund performance forward 10 years, those are highly correlated, of course. I mean, it's directly related to interest rates. So now that we are low, it's come up a lot, but it's still considered, average or thereabouts. It's just not rational to assume that we'd have to go extremely negative with rates to be able to keep up to what we've done in the previous 20 years. So if you've got a situation where both stocks and bonds are probably, not for sure, this is not a guarantee, but probably facing some headwinds compared to the previous 20 years. And the previous 20 years, bonds made 5 to 6%, stock market made 5 to 6. If we're going to cut that down, it's rational to assume that a 60-40, like the Vanguard VBinks, for example, might only be able to swing 3 or 4% in the next 20 years. That was my point. I don't think your AI comment, I think it's fine if people want to, assume that AI is going to have, where's your question? Something to do with increasing productivity. That's fine. We're all entitled to our opinions. I just see headwinds going forward. I see this whole thing as a diminishing returns equation where we're just not going to be able to keep up with this forever. At some point, we're going to have to pay for all of this. So whether it's the next 10 years or 20 years, I don't know. I just think that it's a safe assumption that the next 20 probably won't be as good as the previous 20, which weren't as good as the previous 20 before that. So we're trending in the wrong direction here. And I think it's unfortunately going to continue. So, shameless plug, but definitely VTS spends a lot of time focusing on delta neutral trading, option trading that is, non-correlated to the S&P. We do a lot of those things. And I think it's going to be extremely important going forward for people to embrace option trading because the old buy and hold and let's hope for the best, it might not only 3-4% maybe. So I wouldn't do that. But you do what you want with your money. I'm here if you need help. All right, based on this is the same person, right? No, different person. All right, based on life expectancy statistics, averages if you're older than 60, you should take the 2 million now. If you're younger, you should take the 4K a week. Good comment. Largely agree. We'll get into that in a second, so I'll move on. We'll do that right away because I think people are here for that. Any advice, opinion on selling long-term 6-month covered puts? Kind of the same thing. You said covered. Do you mean cash secured or covered? Like you literally have some shares? I'm going to assume you mean cash secured because you didn't mention your position. So I'm assuming that's what you meant, that like I explained before, you're basically just going to look for something to sell a 6-month put, probably below the price right now. What do I think about this? I think it's fine. I think that selling puts, even naked puts in general, is an okay strategy. But you absolutely need a stop loss. You have to, like I said, 10% total value. If you're a very long-term investor and you have a really diversified portfolio, you might be able to convince me to allow you a 15% stop. But you have to understand, when you're selling that put, it might seem like juicy premium today, but that underlying stock can crash on you. And you are subject to 100% of that downside movement minus the small premium you brought in. It's essentially what's happening here. So you are not reducing risk by selling a put option. There's a lot of people who will convince you that it's fine, it's never going to go that far. I always remind people that the options market is largely efficient. Maybe not perfect, maybe it's not, but it's largely efficient. If there is premium worth selling, if somebody's going to give you 50 cents or $1 to sell a certain strike, you can't then come in and say, oh, it'll never get there. You don't get to tell the market that. The market is telling you, this is a two-sided market and it is quite efficient. The market is telling you there is a significant probability it's going to get there. Because if there wasn't, that contract would be 1 cent. It would be 3 cents. If there was no probability of it getting there and you're going to say, oh, Tesla never drops 30%, I'm going to collect that juicy premium. It wouldn't be juicy in the first place if it wasn't a probability that it gets there. So always deploy your stop loss. Always understand that you're collecting pennies on a put option and it can drop dollars. So collecting pennies in front of the steamroller, not a good idea. But if you do it when stocks are already low, volatility is very high, it'll allow you to get a little bit higher premium and then add a stop loss to the mix, and you should be okay, largely okay. All right. I'll just mark the last question that we got. And now let's get into the poll. So I did do on Twitter, let me screen share here, get to what we're talking about here. Call up my Twitter. So by the way, you can follow me on Twitter. It's at VolatilityVix. I'm not overly active over there. I definitely like making videos better. I can explain things in a 10-minute video much more thoroughly than I can do a stupid little popcorn 280 character tweet. But it is what it is. Some people like Twitter, so follow me there if you like. But the poll that I'm talking about, let's find it here, is this one. Yeah, this one. So we had 788 votes, and I basically said, would you rather take 2 million USD today or 4,000 USD per week forever? Now, this question is kind of a silly question. It's not going to happen for any of us. But the reason that I asked it is because you can actually learn a few things along the way. And typically, people don't actually calculate these things, but I'm a geeky trader. I love to calculate things. So I like going through these exercises, but you can see some of the responses to this. If you're on here, great. There's no right answer, by the way. Everybody had a good point. There is no, mathematically, you definitely do this one. I'm going to get into it in a second why there is no right answer. But, because of my age and family history, I select the 2 million. 2 million today because I can invest it and get a better return. You can read some of these. This person said 4,000 a week forever, protects me from myself. That's a good point. I'll get into that. 2 million compounding from today beats 200,000 a year for life. Okay, we'll run the numbers there. Basically an age poll. Of course, it's kind of an age poll, but yeah, people have different opinions here. So we're going to cover a few things. Of course, the main thing is the investing rate of return, right? If you make a killer rate of return, then taking 2 million today is obviously going to be quite good for you because you can turn that into much more than 4,000 a week. The other thing is an investing time frame. Like that person said, it is sort of a quasi age poll. If you're 65 years old, well, then take the 2 million, right? The 4,000 a year, 4,000 a week forever. That sounds great, but I'm not predicting your end of life. Don't get me wrong. But if you're a little bit older, you might not capitalize fully on that, on the number of weeks you have left. So I don't know if that sounded super grim. I don't know how else to word it. But if you're really young, of course, 4,000 a week, that can compound a lot. Investing discipline. This is a problem, right? If you're going to get your $2 million and the first thing you do is go out and buy a Lamborghini, then it's not 2 million versus 4K a week anymore, is it? It's, you have to actually make sure that you still have the $2 million a couple weeks later. And I know for some of us, maybe we wouldn't. I know for me, it would be awfully tempting not to go straight out there and get that Corvette C8. I've talked about it a lot. I'm definitely buying one. I'm going to get the Z06 or the E-Ray. But I also have a financial rule, just a budgeting rule. I never buy new cars. I always wait 2 or 3 years. Just stay disciplined. Make sure you don't get that massive depreciation hit. But look, if you give me 2 million today, I don't know, maybe I'd get the Corvette. And then, of course, my wife would need something for her because I can't get a Corvette without her getting whatever, her Birkin bag. So there you go. I wouldn't have 2 million for very long. Capital gains tax is going to affect things. And of course, inflation rate as well. So let's actually get into, first of all, the rate of return. So what we've got here is we've got a compound interest calculator. And this person starts with 0 because this test one blue, this is the 4,000 a week person. So they start with 0. We're going to give them a 7% rate of return. Ambitious, if they're a buy and hold investor, they're not going to get that, but let's just give them 7 for now. No capital gains to start. We'll circle back to that. 16,000 a month, basically 4,000 a week. No wages. We're just doing the 2 million versus the 4K, and inflation will add later. So this person is obviously going to do really well. At the end of 30 years, they're going to have 18.7 million and 40 million at the end of 40 years. They're doing awesome. Here's the 2 million, same exact variables, 7%, 0, 0, 0, and 0% inflation. So here's the results. Basically, these two investors, you can see the 2 million person is actually going to come out worse off after 30 years. They're going to be 18.6% poorer. Now, not hurting, obviously not hurting. This person still has $15 million after 30 years, but he will come out less ahead. But this is why it's kind of an age poll, because you can see what's happening here. Obviously, if you get money up front, you're going to be making a lot of money quickly. And this 4,000 a week person in blue, they're going to have to wait a while. So the cutoff for a 7% rate of return with no capital gains and no inflation, which is not realistic, but this is where we're starting, is about 19 years. So I'm 47 years old. I'd have to wait till I'm 66 years old to break even. I have to wait till I'm in my 80s. You know, I want my Corvette today. So probably give me the 2 million, right? So it turns out that the rate of return is going to be about 9%, where we are talking about two investors. Update this, both investors kind of breaking even. It's a 9% rate of return. So we might be able to say, okay, well, if you're a good investor and you can make 9% a year for the next 30 years, doesn't matter which one you choose, you're going to end up the same. The problem is, of course, we do have to add some factors. So inflation. This is why it's a good experiment, because people might not understand how this works, but which one do you think is more punishing for inflation? If we add a 2% inflation rate, who does that affect more? Well, if I update this, and my spreadsheet actually updates, there we go, you can see that the inflation, of course, affects the person who has a massive lump sum of $2 million right up front. The inflation is going to be burning into the entire lump sum from day one, whereas the other person gets a little bit slower bleed of compounding. So it's going to affect them a little bit less. So now, instead of a 9% rate of return, I think it's 12. It might even be 13. Let's see. Let's see what 13% does. 13, no. Let's see 12. Sorry, my spreadsheets are way too long and they're super slow. That's why I don't even have auto update anymore, because it just screws everything up. But if we go 12%, it's about the same, right? So now if you have a 2% inflation rate, you basically need a 12% rate of return for the 2 million to come out ahead. But we're not done yet, because we can add capital gains. So different countries, different situations, but both of these sums of money are way too much to be tax deferred. Of course, you can only put in $6,500 as of 2023 to your IRA, and $2 million is obviously not even close to qualifying for tax deferred. So 25%, a pretty good mix. Again, who does this affect more? Does this affect someone who has $2 million more? Or does it affect somebody who slow bleeds more? Well, again, having a lump sum up front is actually going to be affected by capital gains more, because their money is going to be hit the full amount, whereas the 4,000 a week person isn't. So now, instead of 13 or 12%, we said, it's actually about 16. Come on, stop beach balling on me. Everybody who has a Mac knows what I'm talking about, the dreaded beach ball. Here we go. So let's update this, and I'll show you now if you make a 16% rate of return with capital gains, with inflation, now it's an equal amount. There's no crossover time, really. The 2 million is just better. At no age would you select the 4,000 a week if you're able to actually if you're able to actually make a 16% return. So I didn't mention it in the poll, but my answer, if you were to give me this, it would be to take the 2 million. And that seems a little bit counterintuitive, because I just proved that, look, I need a 16% return long term, like not every year, but an average CAGR of 16%. That's a tall order. I've said a lot that, look, VTS has done better than that, of course. I can even show you our results. We're actually at about 22, right? So we've clearly done better than 16, but I just spent a few minutes explaining why I think investing is going to be harder going forward. So I do have to be fair to myself here. The likelihood that the forward 20 years is the same as the previous 11 years, not 20. We launched in January 2012. But I mean, let's be fair to myself as well, right? I'm not one of those people that disadvantages other people, but gives myself all the advantages, right? There's no self-attribution bias here. I'm saying that, look, investing is going to get difficult for all of us. We should all kind of lower our expectations a little bit. In fact, a couple weeks ago in the live stream, I said, if there was some magical way that you could offer me a 15% rate of return every year for the rest of my life, I'm taking that deal. I'm shaking your hand and I'm going to take it. 15% a year is world class, especially if you're talking about the next 20 years, which could be difficult. So making 16% doesn't make much sense. Why wouldn't I take the 4K? Well, I am 47. There is a crossover period. I am a disciplined person, but I would still take the 16. One factor that sort of affects me, but probably doesn't affect all of you, or maybe even many of you. But as you know, actually, I should probably start with this one. As you know, this is where I am. This is picture taken off my balcony. Well, points for anybody who knows where this is. You can probably identify this building over here. This is the only, I believe, the only considered 7-star hotel in the world. This is the Burj Al Arab, I think it's called, or Burj Al Arab, however you say it. But I'm in Dubai. So what does that mean? Well, I live tax-free. So one slight advantage that I get is that, of course, I will not be paying capital gains. So how does that affect me? Well, now, of course, my $2 million is going to be better off. So I don't have to make 16% to balance this scale because I don't have to pay capital gains. So I'm kind of back to that, let's say 12.5. 12.5. Let's see if that's kind of close enough for this example today. So the $2 million for me, because I don't have capital gains tax, is actually I only have to make about 12%, give or take. So it's not a huge deal. Making 12% a year is still, let's be honest, 12% a year is still a really good rate of return, but it's personal to everybody. But like I said, one of these experiments, I'm not going to give you $2 million or $4,000 a week. Nobody's going to do this. It's a totally silly thing to go through. But there are a few things you can learn along the way. And what I found interesting was my audience is, of course, very investing related. So I do think that the answers people were giving were a little bit higher level. People were at least thinking about it. I even saw a few people try to calculate, the future return of this mystical situation. And it's really cool to go through these experiments. A lot of people just ballpark it. They're like, oh, I actually saw some people saying, if you can just make 6% a year on the 2 million, you're better off. Well, that's fine. I'm not going to criticize anybody, but you probably didn't calculate it right. That's silly. Like 6% of 2 million is not even close to 16,000 a month. So it is actually important to go through these experiments and go through your compound interest calculator and consider these types of things, because on our real capital, these things matter. These thought experiments are actually useful sometimes. So I like it. I'm going to probably think up a new one next week and hit you all with a Twitter poll next week. So make sure you follow me, and let's keep this rolling. Let's do a couple more of these submitted questions. I like these submitted questions. They give me a chance to take a peek a couple hours before the live stream starts, and I can maybe prepare a chart or two if I feel like it might be helpful. So make sure you submit those in the community forum. All right, here we go. In last week's live stream, you shared your personal beliefs on technical analysis. Here we go. I was very critical. Are these beliefs based on your own personal experience of using TA and losing money? No, I've never used TA in any significant amount. I just don't believe that it's a rabbit hole worth going down. That's kind of what was my point, is that I view technical analysis. And what I mean by that is people drawing lines on charts and resistance and flag patterns and doing all these things. I just explained that, look, we're humans, we're pattern-seeking creatures, and what you're drawing on your page has no effect on the market. There's no reason to think the market has to abide by any of that. If you basically, you could draw two different pictures based on two different time frames if you're in a different mood. Like, here's the S&P 500. Well, I don't know. I could be that person who says, oh, look at that. There's a line there. Well, that must mean something, right? I can see a line. And then, well, look at that. That actually kind of looks parallel, doesn't it? Look at that line. Well, now we've got a channel, don't we? So now I'm thinking, oh, well, certainly this thing is going to it's going to extend down, and the S&P 500 is going to come down and hit here, right? The channel. I just drew the pattern on my page, and then, oh, maybe this point right here is something significant, and there's this one. So let's give this thing a silly name. Now I'm doing technical analysis. But if I come back the next day, I might see something totally different. Or if I do a different time frame, if I do a 5-minute versus a 30-minute, the whole thing's going to be totally different. My point is, I promise you, the market is not moving based on these stupid little lines that people draw. My lines are just as dumb as anybody else's. I'm not saying I'm good at this. I have no idea what I'm looking at, but the point is that technical analysis, Goldman Sachs is not trading their client money. BlackRock, none of these people are running client capital thinking that, oh, if it touches this channel, boy, that's going to mean it's going to come back up. And so right here, we're going to double up and we're going to allocate all our cash. But if it breaks through, then that means it's certainly going lower. So now we're going to sell all our client money. None of this matters. I basically gave the example of the 100 monkeys throwing darts. You get 100 blindfolded monkeys throwing darts at the S&P just based on a random number generator. Half of them, if it's buy sell, 50-50 minus trade fees, so maybe it's 55-45, minus the fact that losses are more costly than gains. So if you hit one of those losses, it'll probably go a little bit further lower than the gains goes higher. So probably 30 of those monkeys are going to be profitable. Come back 20 years, you've got 30 blindfolded monkeys throwing darts that are actually profitable traders. Well, we wouldn't be confused to think that these monkeys know something that we don't. A couple of those monkeys would probably be phenomenal traders. That's how a bell distribution works. You're going to have most of them in the middle. And again, it's not 50-50. It's probably going to be 70-30. So it's a skewed bell distribution. But you're going to get a few of those dart throwing monkeys that are crushing me. Here I am working every single day, 10 hours a day on VTS, and this blindfolded monkey's doing better than me. Well, it's not the technical analysis. It's not the pictures. It's just that that's what happens when random numbers in a sequence are organized. You're going to have some on this side, some on this side, most of them in the middle. That's just what happens. So technical analysis is one of those rabbit holes that people go down, that it's actually possible to convince yourself that you've got some edge, that your pictures mean more than the person next to you. And no, I learned from somebody who's really good at teaching me how to draw the right pictures. No, they were just one of the 30 dart throwing monkeys, right? No offense to the person, they're not a monkey, but you get my point that the reason that none of these technical analysis people really can show a long-term performance record that's really consistent and impressive is because it's not really based on anything. And then you follow them, you pay them for their services, and you join their subscription or whatever it is, and it fails for you, right? It almost always fails. Let's be honest, most people will fail doing that. Well, what does the person tell you? They don't tell you that, oh, it's actually because this is just random numbers and technical analysis failed you. They say that you need to work harder. They say that you need to put the work in. You need to put the reps in. This is hard. This is difficult. It takes years to be profitable. It's going to take you 5 years to be profitable. Keep doing it. Keep paying me the money. Keep following my service. Don't worry. 3-4 years from now, you're going to learn how to be profitable. No, you're just going to pay 4 years of fees to something that it's a rabbit hole you shouldn't have gone down. The other example that we used in the last stream was seasonality. We're pattern-seeking creatures. We're going to see seasonality if we look for it, but it doesn't mean that it's a trading edge. Don't go down those rabbit holes. I'd much rather you go down a rabbit hole that actually has a probability of paying off down the road. Analyzing volatility metrics. It's not something that I drew on my page. I gave this example last time, but if the VX30, which is a combination of the front 2 months of the VIX Futures, if that is significantly above the VIX index, the cash index, that is a tailwind for a short vol trade. It's not the end all be all. It doesn't mean you're going to make a whole bunch of money and be profitable forever, but that is a tailwind. It's not something I drew. We're all going to draw the exact same thing. If the VX30 to VIX roll yield is positive, for every single one of us, it's the same signal. If I was selling a service based on that signal, I can't then tell you if it failed, it's because you didn't put the reps in. It's because trading's hard and you have to stick with it. It's something you learn on day one in 1 minute. If this is above this number, if that's above 7, it's the same tailwind for all of us. That's a signal that you can test. You can scrutinize it. You can see if it's right or wrong. You can see when you make money, and you know that if you lost money, you know when it's wrong, right? With technical analysis, you're never wrong. You can just redraw your chart. You can say, well, yeah, it failed here, but I'll just drop my channel a little lower. And there's always a way to convince yourself that it's not the chart, it's just the market. It's the Fed. It's Jerome Powell. It's Biden said something dumb. Technical analysis is a really, really dangerous rabbit hole to go down. I'm always open to evidence. I'm 100% evidence-based person. So if somebody is insulted by what I'm saying, if somebody says, no, technical analysis is incredible, again, I would just default to saying, that's great. I would love to see a track record. I really would. In all the years that I've been doing this, it's surprising. There has been 0% of people who do that. So a lot of people say that it's useful. Hundreds of thousands of traders on Twitter will say that they know what they're doing and their charts got it nailed. It's funny, still 80, 90% of traders will lose money, and most people can't beat the S&P, and nobody's ever going to show their performance, and all those things still apply. So, again, I'm evidence-based. If I'm wrong, then prove it to me. Tell me I'm wrong. Not with words. Prove to me that I'm wrong. I'm not anticipating a whole lot of people proving that. So I don't mean to be negative. I'm actually saying all of this to be helpful. It's a rabbit hole that I understand how tempting it can be, but I don't think it's going to bear much fruit. I don't think there's much edge there. Anytime that you can change something from a 5-minute to a 30-minute and it changes your signal, you're doing something wrong. I can't change the signals for volatility. If the volatility barometer is above or below a certain level, that means something. You can't just make a small little adjustment and all of a sudden the signal, instead of buy, it's now sell. It doesn't work that way. You have to have falsifiable beliefs. And unfortunately, technical analysis is an unfalsifiable claim that you can just continue to move the goalposts. It's really dangerous. I don't see it as being helpful. Apologies to anybody who uses it. I would encourage you to look other places. Just my humble opinion. All right, when do you take profit on your Iron Condor? Do you usually wait to take profit or stop loss to trigger, or can you close the position on a discretionary basis? So for us, I'm going to do that later, but that just bothers me to even look at it. I don't like technical analysis. All right, so we've got an Iron Condor open right now, and the only thing that's going to close this trade is we use a 50% stop loss and a 50% stop gain. So of course, if anybody is in the VTS community, I do have a full Iron Condor course that just comes with the subscription. You can go through all of this. Stop losses is part of this course. There's a couple lessons on the stop losses. And I also sprinkle it all in. Again, the rules of engagement are here. We talk all about the stops, but the only thing that gets us out of the trade is, I think I opened this trade for $1.22 or something. Let's say $1.20 to make the math easy. 60 cents is my stop gain. If it goes from 120 to 60, that's 50% of the premium that I collected. Profit, because it's a Vega negative trade, I want the premium to go down. So I want this $1.24 to go down to 60 cents. When it does, I close the trade for my profit. If it goes up 50%, times 1.5, so 120 times 1.5 is 180. If this premium is $1.80, close the trade for the loss. That's it. Those are the only conditions that I open or close these, or close them in this case. Stop loss. We do not look at this turquoise line at all. This is a long-term Iron Condor with 2 months to go. We won't get anywhere close to expiration. So all we worry about is the pink daily profit line. That's it. 50% stop loss, 50% stop gain. That's our trigger. I don't do anything discretionary. There's always a system behind it, and there's rules in place, and we just follow the risk management plan. Okay. What about using Broken Wing Butterfly on the VIX M3, M5? We kind of know the future spot will converge. We could identify the strikes to sell. Well, it's not totally accurate to say we know that it'll converge. What we do know is that the front month VIX future will converge to the spot VIX index on expiration day for 1 day only. At expiration on Tuesday, 25 days from now, Tuesday night, basically Wednesday morning, if you include the silly, special operations thing that goes on, we know they're going to converge. But you're talking about M3 to M5. There's no convergence there. So there's nothing wrong with trading the VIX index. Like, I don't want to give you the impression that, no, you can't do that on the VIX. Of course you can trade the VIX. One of my most profitable strategies is VIX options. I love trading the VIX, but you can't use the same strategy you use for a short volatility ETP and apply that to the VIX or longer dated VIX futures, because there's no predictable decay factor there. It behaves differently. The VIX can stay low and just kind of flatline up and down at a very low, stable level, whereas the VXX and the UVXY will continue to decay. So as I mentioned, the whole Wayne Gretzky quote, how come he's so good? He skates to where the puck is going to be, not to where the puck is today. Well, we're taking 2-week trades on the UVXY. I'm trying to skate to where the puck's going to be 2 weeks from now, which is a VXX decay factor of probably 4 or 5%, as long as the roll yield is positive. So I can set up my trade to profit from that. I can actually lead a little bit, like I showed before. This VXX trade, here's the price right now, but 2 weeks from now, I think I have 14 days. Yeah, I have 14 days to go. If things stabilize, the puck's going to be over here 2 weeks from now, right? I ignore the turquoise line. I'm just looking at the daily profit line, but I do know there's going to be a decay factor here. But with the VIX, you can't say the same thing. You can't say there's going to be a decay factor here. Why would there be a decay factor? The VIX doesn't work that way. It's totally disconnected from that. It's not, VIX futures are a freely traded market. VIX index is calculated based on S&P 500 options. There is no connection there. It does converge on one single day, but no, I would say you want to stick to an entirely unique strategy for the VIX and a totally separate decay-based strategy for volatility ETFs. Keep them separate. My VIX option strategy has nothing to do with my volatility trend. They're not even close to the same thing. They're both very profitable and they both do well for different reasons. So no, I would say that's not a good idea. You don't want to start applying the similar thing. I would say you're probably looking at straddles as being the most efficient trade. You could look at calendars, but again, you're bringing in another element, which is the volatility levels. I typically stick to calendars on the VIX because it's a more neutral strategy. Butterflies are pretty good for capturing out of the money premium because of the way they set up. It's actually cheaper to throw. Why did that disappear? It's actually more efficient to do a butterfly here because I'm doing an out of the money. So this is actually much cheaper. I can get a lower premium here. But the VIX, you're not going to be doing anything out of the money because you're not expecting future prices to be any different. Hopefully that makes sense. If the VIX is 20 now, you're not expecting a decay factor, so to speak. You're just discretionarily guessing on where it's going to be. So totally different strategies. All right, I'd be happy to understand why you prefer in your Iron Condor strategy, I assume, to take 50% profit in the middle of the trade instead of just in advance take higher probability trade with 50% less credit and keep it till expiration. Commissions aren't a factor in your options trading. So commissions aren't a factor really at all anymore. Like it is a factor. You pay for commissions, but it's a reasonable price these days. You're just paying for the contract size. So yeah, if you leave it to expire, you might save a little bit, but don't ever deploy a strategy to try to save a few pennies on fees. You want the strategy itself to be optimized. So why would we do this? Well, a couple reasons. First, let's look at our Iron Condor that we have open right now. Why wouldn't I let it expire? Like what you're essentially saying is, why wouldn't I reduce the allocation size and then narrow these wings to the point where it's 50-50? So the gains and the losses are the same. And then you could just run the experiment. Well, hopefully you have more wins than losses, right? If they're 50-50, then just let them go and see how it works. Well, remember the options market is efficient, so you would probably expect your profit to be near zero if that was what you were doing. You still need a timing edge. You can't just on a calendar schedule sell volatility. It doesn't work that way. You'll have just as many winners as losers. Minus trade fees, you'll probably lose 2% long term. But really the reason is the gamma risk. Basically, the longer I let this trade go, the delta and the gamma are going to be increasing, and my trade's going to be more susceptible to price movement. So right now, I still have 56 days, I believe, 55, maybe 56 days. So I opened it maybe when it has 70. We like to stick to about 40 to 70 days to expiration. And then if you do get a price shock, it really doesn't do much to the trade. But if you let it go here, these price shocks very close to expiration can really change your fortunes quickly. And that's not what you want. You actually want to be in control of a very slow moving trade because we do want to stop loss out at a reasonable level. If you're just going to set up trades to let them expire, you're basically flipping coins at that point. I don't think there's a whole lot of edge there. So what we do is we like I explained before, the 50% stop loss, stop gain rule. That's the most efficient way to do it. What I want to do is I want to open a trade that has maybe, like I said, 45 to 75 days, but typically about 60, 65. And I can make my 50% premium pretty quickly, within 3 weeks, maybe a month. I can get that and I can be out. I can put my capital to a brand new trade and I can siphon off the top decay factor without having to wait 65 days, right? I can wait 3 weeks and get half the money, or I can wait another 2 months and get the rest of the money. It's just not an efficient use of capital. I really want to sell them when their volatility is mid to high, and then burn that top volatility off, take half of it, move on. Take half of it, move on. It's actually, the time frame is much shorter going to 50% rather than waiting the entire time to expiration. That's a long time to wait for an extra 50%. I'd rather just put my money to something else and keep, churning 50% trades. It's just much, much more capital efficient long term. So the gamma delta is a problem. We call that dancing on the gamma knife edge. If you let your trades go close to expiration, you can have a trade that's looking very good, and then you wake up the next day and it's basically almost full loss. You don't want that. And then secondly, of course, capital efficiency. You always want to be churning your trades to get the first half of the premium. It's not worth it to wait for that second half. It takes forever. All right. We're doing good today. I'm fairly disciplined here. We're bouncing around pretty well here. Let's keep going. Okay, Bryce has this one. Barclays announced a reverse split 1-for-4 on March 7th. Did they? I have not seen that. I'm not on Twitter much. Usually that's where I would see the announcement. Somebody, one of the usual suspects, Vance Harwood, somebody's going to tweet out that it was announced. So I can't confirm or deny, but that would be fantastic. UVXY, hopefully they do one as well. Like I explained, the premiums right now, while it is technically the same thing, a reverse split does nothing to the stock. The ETF doesn't change, doesn't even change the options. Everything's exactly the same. They just adjust the contracts, adjust the price. Everything's the same. Adjust the open, the share count. Nothing happens. But there is two effects. Number one, for option traders, it's more efficient if the price is higher, because the distance between a $1 strike gap when it's 50 to 49 is much tighter than when it's the UVXY right now, 50 to 450. That's still, relative speaking, that's not a whole lot. You're going from significant premium to pennies really quickly if it's down at the 4s and the 5s. So reverse splits is always going to be helpful for option traders, even though technically it's the same thing. Now, I always have to give a fair warning here when I say it's exactly the same. That is true. It is identical and there's no effect. But with a reverse split, if you do have options open, it's probably best to close those positions and then wait for the new option strings reflecting the new prices to launch, because those will be more efficient. The market makers have more incentive to manage those better. And the old strings, while they're technically there until they're gone, until they're expired, your trade won't be closed out, it won't be affected. But the longer you wait after the split, your liquidity will probably decline. So once you are aware that, okay, VXX is doing the reverse split, I have options open, it's not a bad idea to take a week or two off, or, do something longer term, something like that. But you do have to be aware that after the split, you probably want to get into the new option strings. Just fair warning. Okay, so I moved to Dubai. Yeah, been for a while. You can't argue with it. It's a phenomenal place. I'm not going to get into it here too much, but yeah, I'm here. I'm here for good. I don't know for good forever, but it's a pretty great place, as I showed. I can even show you. This is for something totally different that I was doing, but since it's open, I can actually show you. I'm actually waiting to buy a place. Oh, I have to do a screen share so you can see it. This is just an Airbnb right now, but I am actually looking to buy a place. But the place that I want to buy in, this is called Emaar Beachfront. This is the Palm Jumeirah. I'm sure you can see the shape of it. But this won't be done until about 2025, maybe 2026. And right now, this building is open. You can move in right now. I think these two are opening within a couple of months. But these ones are still way under construction. So they're kind of touting this as the Miami Beach of Dubai. It's going to be a new, really high-end district. I like being near the water, near the harbor. So this is what it's going to look like. This whole thing is a mall. It's basically a 2-3-story mall, which is going to be pretty cool. I always like living near them. You get the movie theaters, you get the cool stuff. Pretty awesome place, but it's not going to be ready. Side note, the Dubai Boat Show, which I'm super excited about, is next week. So right now in Dubai Harbor, they're setting up all the tents. I went out running today. I ran past it. Cannot wait for that thing to launch. But yeah, that's what the Emaar Beachfront is. So I live in Dubai now. It is true. But I do spend the majority of my time still in Taiwan because, of course, my wife's Taiwanese. And we live there most of the year. I think I'll probably be in Dubai maybe 4 months, 5 months, something like that. What do you do in the summer? I was here last summer. The reason I came here is because I wanted to finish my options course. And I thought, well, I have no friends here. It's going to be blistering hot in the summer. I'm not going to even want to go outside. I'm going to get a ton of work done. I did get a lot of work done, but the summers here are fine. It's totally fine. You'd think it wouldn't be. Like I golfed one day and it was 49 degrees. You'd think it would just be unbearably hot, but first of all, I like the heat. I lived in Houston for a couple years. I lived in Scottsdale, Arizona for 5 years. I've lived in California for a couple of years. I've lived in a lot of hot places. I've golfed, like I played professional golf. I traveled around Asia. I played in Thailand and Indonesia and all these really hot countries. Singapore, quite a few tournaments there. So I'm totally used to the heat. Played in Venezuela and South America. 49 degrees in Dubai was hot, but I played 18 holes and I finished. But the cool thing is, in the evening, it does cool off substantially. So it's really nice in the evenings. Even if it's a hot summer day, everybody's out at night. It's a really busy place. People are, it's still hot. There's air conditioning everywhere, absolutely everywhere. They even blast it into the promenade. So you can be walking outside and basically you're walking in a semi-air conditioned place. It's not cold, but it's cool enough and pretty cool. No problem at all, Dubai in the summer. Nothing wrong with tax-free living too. But it's also amazing. Like there's zero crime, literally zero crime here. That's a benefit. Yeah, consider it. I had an email from somebody, a friend of mine, just I haven't responded yet, so hopefully he's not watching, but talking about opening a company here. That's what I did because I haven't bought my house yet. Start a company, save money on taxes. I don't know. It's not a recommendation, not financial advice. All right, for an Iron Condor and other asset classes, it is also common to get $1.20 premium. Well, it's going to depend on the stock price. It's going to depend on the time to expiration, the volatility levels. But relatively speaking, it's just a trade. It's just an Iron Condor on a different asset. So it'll all work out just fine. And we'll still use the 50 stop gain. So it doesn't matter what asset we're using. On a brief look, it seems like the premium is generally less. It definitely could be, like I explained on the VXX, the UVXY, once those prices go low, yeah, you're not expecting a whole lot of premium because the gaps between these strikes might actually be small. Remember, with an Iron Condor, the only reason the premium is what it is because it's a $5 strike gap on the S&P 500. But if we do a $1 strike gap on the TLT or a $2 strike gap on the GLD, the gold ETF, it's all going to be different relative premiums. If you do a $2 strike gap and you get 50 cents for that short Iron Condor, that's a 1-to-4 ratio, right? But the same thing would be $1.25 on a $5 strike gap for the SPY. Basically, it's the exact same relative premium, even though one of them's bringing in 50 cents and one of them's bringing in $1.25. It's going to be the same thing. We only care about relative differences. It's not like it's a weaker trade because the TLT only brings in 40 cents. If the strike gap's $1, that's 40 cents on $1 is a significant gap. You'll understand when we start doing more of them. 2 million now. We already covered this, but yeah, I went with the 2 million. With good money management, I can make 10 to 20,000 every week. Every week. Look at you, big baller of an investor here. 2 million. Can you? I'd like to see that. I'd like to see that. That would make you easily the best investor in the world, but maybe you are. I don't know. I do not know you. Wouldn't want to doubt you, but that would be phenomenal. Now all you have to do is get the 2 million, and then you're golden after that. Every year, there are many traders using technical analysis listed in the U.S. Investing Championship. Verified gains much greater than 20% annually. Again, random number generator, Bell distribution. If I entered that competition and you entered it and we all entered it and everybody in the chat entered it and we all just did this and just randomly did stuff, a couple of us would turn out to be really impressive investors. Our rate of return would be phenomenal. You'd be like, wow, how did he do it? Well, you lined up 100 people and 10 of them are going to be phenomenal, right? Just based on random luck, just on numbers. So if you were to show me somebody that did it year in and year out for 20 straight years, not every single year, but a rate of return much higher than 20% annually for 20 straight years, well, then you're talking about somebody who's not really very smart, are you? Because if you could do that and you could prove that, why would you go to the U.S. Investing Championship, which I've never even heard of as a trader? I didn't even know that was a thing. It's probably not very, not very worthwhile an endeavor. Why wouldn't you just go to Wall Street, prove your rate of return, and pick up your bag of $10 million a year? It doesn't sound very smart to waste your trading skills on something like that when, somebody like, not Warren Buffett, he's been investing a long time, but Ray Dalio, $20 billion. Why not just start that? Like just go get the $1 billion. Don't go to the U.S. Investing Championship. Go get your $1 billion on Wall Street, obviously, right? It scales way better if you can make significant profit and you can show consistency and it's actually based on an edge. We're talking about the financial industry here. There is literally trillions of dollars at your disposal. All you have to do is be able to prove it. That's it. It seems like the easiest thing in the world. Oh, you make 50% a year? Prove it and go pick up your $10 million. It's a bag right there. It's right there. Just go prove it. It'll take 5 minutes. Just get an audit, pick up your bag of $10 million. It's amazing how few people actually do that. Nobody seems to want the bag of money that's sitting there. Nobody wants to do what everybody would do. This is one of those things, like I don't have to meet the person to know that it's not true. You have to apply what I call the what would you do rule. It's a general rule. Whenever you see somebody making a large claim, an outlandish claim, what would you do? If you were a person who consistently could make 30% a year, every year for 20 straight years, 30, 40, 50%, whatever these people on Twitter are talking about, if you could do that, what would you do? Would you compound your small account over 20 years? Or would you just go get your bag of $10 million? Of course, you'd just go cash in on your incredible skill. You'd amplify it with 1,000 clients with high net worths, and you'd get 1% of their money every year. Obviously, that's what you'd do. All these people that say, no, I would prefer to just be anonymous and just turn my 20 grand into 50 and then trim it off and do 20 to 50. And I don't need a Lamborghini. I don't need a nice house. It just doesn't make much sense, right? It doesn't pass the what would you do rule. The what would you do rule is investing is extremely difficult. There is very, very few people who can even make 10 or 15% a year consistently long term. For some reason, everybody on Twitter is just, 50, 100, it's no big deal. And yet none of them go pick up that bag that's sitting right next to them. It takes minutes to prove an investment return. Minutes. There's a bag like 10 feet away from you. Just go pick it up. So yeah, sometimes it sounds like, oh, I'm calling you a liar. I'm not calling you a liar. I'm not insulting the people that you know that said that my uncle's cousin makes 100% annual return. Whatever they said, it's fine. This is investing, and people don't really know what they're saying when they say these things. Probably what it means is somebody had 1 or 2 good years, which is totally possible. There's a lot of people who might use technical analysis and make 41% in 2022. And then what they do, just naturally, because we're humans, they extrapolate that forward 30 years. They're like, well, if I did that in 2022, well, I have a 41% CAGR. So I guess that means I'm 3 times better than Ray Dalio, right? I mean, Ray Dalio's worth $20 billion and his flagship fund made 10.8% annual return since 1990. And he's worth $20 billion. If you can do better than that, just go get your $20 billion. It doesn't make any sense to sort of hide in the shadows and just talk on Twitter. It just doesn't Doesn't scale. Sorry. It's one of those things. For some reason, people take a very short period of exceptional return and just feel the need to extrapolate that forward. Like, yeah, it's just always going to be there. No, it's probably not. To make a 40% return, you're taking on a lot of risk. And that risk is a double-edged sword, and it's probably going to bite back at some point. And your 40%, after your next bad year, it's going to go down to 20. And then you're going to have a couple good years, and you're going to think, okay, it's fine. And then you're going to have another bad year, and it's going to go down to 15. And eventually, your compound annual growth rate will probably go down quite close to what we consider world-class investing. 15% a year, you're one of the very best in the world. Not in 1 year. There's millions of people that made more than 15% return last year. There's almost none that made 15% for the last 15 years. That's the difference. And for some reason, humans like to extrapolate to the future, even though that's not really how it works. So if you know somebody, or if you are somebody that made a really good rate of return, the best thing to do in that situation is to stop, to analyze why it worked, try to figure out why it worked, try to figure out all the spots that it's going to fail if you keep doing the same thing, because you took on a lot of risk to get 40%. I guarantee you that. Try to figure out why it worked and where it can go wrong, and fix it before it punishes you. This is what very few people do. This is the whole Las Vegas thing. You go into the casino, you play roulette, and you actually win. Well, very few people can just say, well, that was luck, and I'm going to just take my chips and leave. Nobody does that. They're just going to keep playing. They think they've got an edge. They think, wow, I made $4,000 last night. I'm going to go back today. I'm going to make another 4. It's easy, right? You're just supposed to put your money here and distribute it in these 6 numbers. And if you do it in a certain order, I've got an edge, right? I can beat the casino. Nope, you cannot. It's just a random number generator. When you line up a sequence of numbers, a small percentage of people will win a lot. Most people will lose. The longer you play, the more you'll lose. It's the same with trading. If you're taking on enough risk to make a 40% in a single year, you're taking a lot of risk, and the longer you play, the worse it's going to get for you. So I would say take your 40 and run, and then figure out how to get 15 safely. That would be my recommendation. Don't continue to try to make 40 the next year. That's a really bad idea. All right, enough ranting. No offense to anybody, of course. When we have one Iron Condor working and we decide to open another one, should we open the second Iron Condor with a position size of 3% of the net liquidation value? Yes, always 3%. The way that the Iron Condor strategy works within the rest of the portfolio, because Iron Condors are a pretty capital efficient trade, you don't want to use your full 20%. That's just taking on way too much risk. That's of course, if you get wins, then it's great, but losses are very costly. So what we do is we use a 3% allocation size. You essentially just take your net liquidation value. This is our live stream account. I would take 3% of this value, and that would be the maximum loss. That's how you scale those. And it's going to be the same no matter how many layers we do. Market's recovering a little bit so far. But yes, all 3 levels will be the same 3% allocation size. It's just best way to manage the risk. It's better to have 3 small positions than 1 or 2 bigger positions. Always. It's just a better use of capital. Where do you go for this? Say I have a strategy edge that's great. Like, where do I go to raise money or create a fund? It's a good question, but honestly, it's a question that if you have to ask, it's probably not something worth pursuing, because most people they just do it, right? It's kind of like starting a business, right? There's a lot of people who go online and they'll watch a million YouTube videos about how to start a business, but somebody who's an actual entrepreneur, they just start the business. They don't watch 100 YouTube channels about how to do this thing. They just do the thing. They don't come on and, I don't have a fund. I am certified. I have all my certifications. I could start a fund, but I like to be, location independent. I like to help everybody from around the world. If you're a fund manager, of course, you can only manage capital for people in your jurisdiction where you're registered. So it's very narrow for me. It would basically be Canada and most likely Vancouver. So the main reason why I do a subscription is just it's global. As long as you enter the trades yourself in your own account, I can help you whether you live in Sweden or Japan. It doesn't matter. But if I'm a fund manager, of course, I'm going to be raising capital basically in Vancouver. So, but if you have to ask me this question, essentially, what would you do? Well, the very first thing that you would do is you would get it audited to prove it, right? So did you do that yet? If you haven't done that, then I would question whether you have confidence that you're actually onto something. Because it's like I said before, the what would you do rule. Well, if you're a phenomenal trader, what's the first thing you would do? You would start sharing your results with the world. I started sharing my results in 2006 online. I didn't even start making money with VTS until 2012, but I was sharing my results online for years before I collected any money. The reason I have a subscription service, this was not a plan. This was people asking me, hey, I see your results on your website. That's awesome. Can you email me the signals and I'll send you $50 a month? That's how this whole thing started. I didn't plan any of this. It's just demand from showing my results. So the first thing you need to do is show it, prove it, and then the rest is kind of easy. The rest fills in for itself because like we all know, or like we should know, a lot of people on Twitter don't know this apparently, but like all of us investors should know, investing is very difficult, and getting a consistent long-term return above about 12% a year, long-term, not in 1 year, not in 2 years, I'm talking about long-term, that's really difficult. So if you are saying that you've done it, prove it, and you're halfway there already, and then get certified, which is not difficult. You just pass the courses. If you can't pass those, you shouldn't, if you can't pass a Series 65, then I don't know what to tell you. You could probably do that without studying. I always think it's kind of funny when people brag like, I am a certified financial advisor. Yeah, it's probably the easiest test I've ever taken. I took all of them as well. I couldn't believe how easy it was. So do that second, and then start networking. If you have something concrete, it won't take you very long. And look, if you start today, there probably are rules in the US, like if you take your Series 65 or 67, whatever minimum level, you still probably can't have your own fund. You have to work for somebody else, probably for 4 years, but maybe 2. I don't know how the US works. Canada might be a little bit different. So maybe it's not you directly as the CEO of the fund, but you can network your way into something really quickly if you've got something concrete. That's the problem. That's the missing element that all of these people overlook. Where's the evidence? Nobody cares what you tweeted, right? So you need to share it, you need to prove it, and you need to back it up and explain it. When you've got that, trust me, finding the connections to the fund managers that would say, yeah, I like what you're doing. I'm awesome at raising capital. I've got a lot of high net worth clients. Most of these asset managers don't really have a strategy that's marketable, that has concrete evidence of really good performance. If you do that, they'll gladly partner up with you. That's what they're looking for. They're looking for somebody who fills in the gap of what they don't have. 85% of asset managers can't beat the S&P. If you're walking in there with concrete evidence that you are amazing investing, you'll make connections pretty quick. I think the rest will fill in itself. But kind of like I said, if you're asking me, you've missed a few steps. You should already have that ready to go. And it should all be very organized. It should all be very marketable. It should all be done. To get that done, it shouldn't take long at all. A year from now, you could be well on your way. And 2 years from now, you're picking up your bag of millions of dollars. It's all based on the fact, of course, that what you're saying is, you've really got something unique that crushes everything else out there. It's probably like what most people find out, it's actually a lot harder. And the longer time frame you stretch it out, the more everybody comes back to reality. Even those superstar investors, they kind of come back to reality. Getting much more than, like I always say, 15% a year, deal. Give me that right now. I'll take it. Okay, some legendary traders have won the U.S. investing championship. Many have levered to great firms. Just research it. That part I can probably agree with. That second part where you said many have leveraged to great firms. That's the missing element that I'm attacking here today. I'm not attacking the first part or the second part. I'm attacking the first part, that these mysterious traders are incredible at what they do, but it never goes any further. Doesn't go past Twitter. They're just, I'm amazing. My results are awesome. I make 70% a year and I tweeted it. Okay, no, you didn't. You're a complete liar, and that's not how money works. There's trillions of dollars in the financial industry. If you can prove what you're doing, then go get it. That's what I'm questioning. If you follow it up by saying some of the very best people that have proved what they're doing, then they went on to do exactly what I said that every single one of us would do, the what would you do rule, you'd go get your bag of money. If you're telling me that some of them did go get their bag of money, well, now I'm not disputing it anymore, am I? Now you're doing exactly what I said that a person who's good at investing would do. Look, I'd like to sit here and say that everything I do is completely to help people. I'm just a super nice Canadian. I'm only here to help you make money. That's largely true. I am nice and I do like to offer my time, and I'm here on a live stream answering questions, and I've never asked somebody, oh, are you in the community? Do you pay my subscription? Nope, not answering yours, not answering yours. No, I'm offering my time. But I get paid. I make money. I am a very good investor that went to get his bag of money. I would be a liar if I didn't get my bag of money. This is what I hate seeing on Twitter. I actually get criticized sometimes for having a subscription service. Think about how dumb that is. I know some people think that it's a real zinger, like, oh, look at this guy, he's got a subscription. Why wouldn't I get the bag of money? It doesn't make any sense to criticize somebody for getting paid for their expertise. It's a totally stupid argument. When people say it, they think they're saying something clever. What they're actually doing is they're clowning themselves for not understanding the very basic concept of having expertise. Every single person who has expertise should go get their bag of money in some capacity. Some people do it through a subscription and they make a lot of money doing that. Some people do it on Wall Street. They make a lot of money doing that. Some people do what you said. They prove it in whatever the US investing. I've never heard of it. I'm sorry. It's probably not that prestigious, but I could be totally wrong. I'm going to Google that later, and maybe it's the best thing in the world. But everybody who has an expertise, if you just understand the law, you're a great lawyer, you're going to get your bag of money. If you're an engineer who makes phenomenal buildings or bridges, you're going to go get paid for it. That's how the world works. That's why I always refer back to the what would you do rule. Well, I did what this person did. I posted my results online publicly for almost 15 years now, and I went and got some money for it. And I do get paid nicely for it. Why is it a zinger to say, oh, this guy's selling his expertise? Yeah, I am. There's a lot of people who pay me for my expertise. That's actually a point of pride for me. You're not insulting me by saying, oh, this guy has a subscription. You're complimenting me. I am in a position where people find it beneficial to pay me money for my expertise. Yes, I'm proud of myself. It's not the flex that people think it is. So it's the same thing about these traders that are apparently just crushing it. They better do this second thing. They better go get their money in some capacity. And then if they do, I totally believe it, because there are people that are very good at investing. There aren't many, but they are out there. I'm not denying that they're not out there. I'm only denying that they're out there and then it never occurred to them to capitalize on it financially. That I find unbelievable. It's far more likely that that person isn't a good trader or just had 1 or 2 good years, because everybody who's actually good at it, well, there's 30 different ways that you can go get paid for your expertise. I only trust people who find ways to monetize their expertise. If somebody's out there doing it for free on Twitter, I'm sorry, but I just can't take that person seriously. It doesn't add up to me. I would never hire a lawyer to defend me in court that said, don't worry about the money. I'd be like, don't worry about the money. You just lost your job. I want you to say, I'm so good, I charge double, but it's worth it. Then I might consider hiring him. Anybody who says I'll help you for free, okay, your service is worth nothing, right? That's what that statement means. So I wouldn't trust anybody who says, no, I'm cool with I can just take my small account and I can just compound it really quickly. That's fine if that's your choice, but that's just doesn't pass the vibe check is all I'm saying. This makes perfect sense. Yes, go to this championship, prove you're awesome, audit your results, get a name for yourself, network in the financial industry, and I'm sure these people are making millions of dollars. That makes sense to me. All the Twitter gurus that are making 100% a year but don't ever pick up their bag of money, that just doesn't vibe with me. Sorry. That's legit. More questions. You can post whatever you want. It's just, do people believe you or not? I guess that's the thing. Like, auditing personal results, you probably don't have a track record long enough to impress anybody. So it really just comes down. That's what the financial industry is, right? Do people believe what you're saying? And the only way to really know that is to scrutinize it. One of the reasons why you will almost never see a subscription service last very long, like, trust me, I've been in this for so long now, well over a decade. One of the reasons why they all kind of crash and burn is because it's actually quite difficult to post results publicly and not have 1,000 people who are following the signals criticize you for being a fraud and a liar and start blackballing everything. It's actually, it fizzles out and dies pretty quickly. So the subscription services that you see on Twitter, they almost all of them have a very short shelf life, because it really doesn't take long before people realize, this guy was saying he makes 50% a year. I joined. As soon as he finally launched this inevitable subscription service, and then they start paying you money and it immediately fails. Like, it really does fizzle out and die. And I know there's people that want to get their money for a year or two. They want to kind of see how long they can go before there's just too many people to block on Twitter and to stop talking and have them sign non-disclosure agreements that they won't trash talk you. All these things that these subscription services do, these are all major red flags, but they don't survive for that reason, that once you start showing results, you're accountable for those results. And what most people find is that actually investing is really difficult. So you do see a lot of people on Twitter, they'll tell you that, oh, I've made 50% a year, I've made 100% a year, like shorting volatility. It's so easy, I just sell UVXY calls, I make 75% a year. The moment they launch their official subscription service and people start paying money for that subscription service, just like that, there's a difference now. Now they're not a follower on Twitter. Now they're a paying follower that is going to be looking at your results and expecting that the way they followed you for 2 years, these astronomical returns that you were telling everybody and tweeting everybody, well, now they're a paying subscriber. You better deliver those results. And it never happens. It always fizzles out and dies. So then there's all these arguments back and forth, and I've seen it happen a million times. So that's probably what happens to most people who have astronomical returns. It's either not true or it's very short-lived. So yeah, I would say you're going to have to find a way to share your work, prove your work. And I'm not doubting you. Maybe you're awesome. Like, there are people, there's 5-10% of the population that it's worth paying them for their expertise. That's how this works. Probably 90% isn't worth it. 10% is. There are people who are good at investing, but because you probably can't vet them accurately, you're just stuck with a list of red flags. Just go down the list. And I've beat it to death, but one of them is the what would you do rule. Is what they're doing, does that make sense? Is that what you would do if you were in their position? Answer is usually no. Okay. The butterfly position opened yesterday. I only took 5 because not all that familiar with butterfly. That's fine. You can take one contract until you're totally comfortable with all of this. Today, VXX up 5%, yet price of position not really changed. Can you explain why? Let me check the pricing for you. Okay, VXX. So when I opened it, I did a video, so I kind of broke mine into 2 purchases. But what is this 12, 11, 10 paying? That's not right. Wait, there's something wrong here. 10th of March. Is that right? Oh, I locked it. I'm an idiot. Okay, ignore that whole thing. Yeah, that was not adding up at all. So 30 cents. That's about right. When I opened my first wave, I got 30 cents, and I saw it as high as 36 towards the market close. And then today it dipped as low as 27, and I can see now it's back to 30. So I opened mine yesterday around 1 in the afternoon, and my trade looks to be about break even right now. So yeah, I would say that You opened 5, you divided it up. It probably should be the same price now. What am I looking for? Your question here. It's probably the same price now as it was before. So I'm not saying that you should go open it. If you're not familiar with it, just leave your 5 contracts. It's fine. What you're really trying to do, you're not going to miss out on anything. You don't have to take all the trades, and if you miss some of them, then you feel like you're missing out. What you're trying to do is build investing, strategies, a successful portfolio that will carry you 30 years. What you do in the next 6 months isn't really going to make a dent in the 30-year time horizon. So take your time. Make sure that what you're doing makes sense. If you're following me for the first time, if you just joined and you're just starting, you've only seen me for a month, and maybe you think I'm trustworthy, but you've only seen it for a month. Paper trade if you have to for a few months. I do post results on my website every single month. I've been doing that for, well, I posted my first website. It was called VIX Trader. That was back in 2008. So I've been posting results for 15 years now publicly. Paper trade for a couple of months. See if my results on the website are matching up with what you're doing. If they don't match up, it's only one of 2 things. Either you're making a mistake or I'm lying. It's one of those 2 things. So if you find out that you're making a mistake, we can fix that. If you find out that I'm lying, well, we have a problem because I have a large community that follows me, and they've been following consistently for, over a decade. They're all idiots. If I'm lying, they're all idiots. But I think my community is pretty intelligent. So I think probably more likely you're making execution errors, and we can clean those up, no problem. But yeah, stick with your 5. I think that's just fine. Especially since it's, number one, it's a layer down because it's option trading. So there's a little bit of a barrier to entry. It's not as simple as stock trading. And then secondly, it's on a volatility ETF. It's on the UVXY. So that's another layer of expertise. It wouldn't be a bad idea to just take one contract size for a month or 2, just to see what's going on. Yeah. All right. Yeah, I can never tell, like the vibe. Sometimes the things I say, because I'm just a very blunt, honest person, right? I always preface by saying I could be wrong. There are exceptions to all the rules. You might be the exception. Like, I was a professional golfer. The odds of making it as a pro golfer are this. That's the odds of making it, and I made it. How? I was born in Canada. I didn't even golf till I was 15 years old. I couldn't break 100 when I was 15. When I was 16, I started winning tournaments. I went from breaking 100, for anybody of you who's golfed before, breaking 100, breaking 90, these are milestones. I broke 100, 90, 80, and 70 in my first year, and I was winning tournaments by my second year. It happens, and I'm not the only one. The people that I was competing against in those tournaments, the very high extreme people, they have stories like that as well. They went from a 30 handicap to a scratch golfer in a year. This is what happens. There are exceptions to every rule. But the odds of making it as a pro golfer from Calgary, where 6 months a year the golf courses are closed because it's covered in snow, it's 0. But I still made it. Now, if I heard somebody say when I was, 20 years old, oh, you can't make it as a pro golfer. If you start when you're 15, you're already 10 years behind. Then you live in Calgary, the courses are closed for 6 months. You're never going to be able to compete with somebody who was born in San Diego and started when they were 4 years old. And I would look at them and say, I agree, but I'm the exception to the rule. So you might be the exception to the rule. When I speak, I am speaking in generalities here. I should probably be more careful with my words to make sure people know I'm not sometimes you say you can't do this, you can't do that. I don't mean you. I mean the proverbial, generally speaking, you. I didn't mean like I'm calling you a liar. You might just be the best trader in the world. And if you are, you need to prove those results as fast as possible because there's millions of dollars at your disposal if you can do it. If you can't do it, you tried your best, and you'll probably learn a lot along the way. All right, let's say that you think you're an awesome trader and you think you can do this. Well, what happens? Worst case scenario, you're wrong. But along the way, you would have gotten certified, so you can still be a successful financial advisor with those certifications. So it was not wasted time. You should still pursue this. You would have launched a website. You would have learned a few things about graphic design. That's never a bad thing. In the social media age, that's always a good skill to have. You probably would have started writing some articles. I would recommend you write an article a week and put it on your newsletter. That's a good skill to have. You should start making videos. You'll learn about video editing. You'll learn about YouTube. You'll learn about search engine optimization. All of these skills you learn along the way are valuable. And then it turns out that your 40% annual return, well, if you go a few longer years, it turned out it was only 13. Hey, 13% rate of return. You're still in the top 5% of the world. You can still have an exceptionally good career at that rate of return. You just, maybe you're not the all-star standout that's going to, put Warren Buffett to shame. You're probably not that, but all of this is valuable and you should go through this experiment. If you want help, of course, email me. But like I said before, people that succeed tend to just do it. They don't tend to ask other people how to do it. They just do it. Like I've never asked anybody how to do this. How did I get here? Why are you listening to me talk? I didn't follow any template. I didn't do anything like, watch 30 YouTube videos and figure out how to start a business. I just started the business. You need an LLC? Go start the LLC. You need to prove your results? Start a website and go show your results. You need to get your name out there? Well, you need to write? Okay, start writing. You need to make a video because this is social media age and kids these days have the attention span of a squirrel. Okay, you need to start making videos. Don't ask me how to make it. Just make your videos, right? That's what I would suggest you do. More do, less plan. People, what is it called? Paralysis by analysis. That tends to be what people do. And true entrepreneurs just do it. You should be on step 20 before you even ask for help. And so I know you can do it. I've seen your work before. I've seen all your posts. I know exactly who you are. I know you can do this. So I would say it's an excellent experiment to go down. And win or lose, best case scenario, you're 3 years away from being a multimillionaire. Worst case scenario, you learn 7 different valuable skills along the way and you have a successful financial advisor practice. Good for you either way. I would say go for it. You're right. I didn't answer that second part of your question. If the VXX is up 5% today, how come the butterfly price hasn't changed? It has changed because at market close yesterday, it was 36 cents and today it's 30. So as the price gets further away, I shouldn't use my hands. I should use the actual trade. When we opened the trade initially, it was about here. But yesterday, the market actually brought it back down and this premium went all the way up to 36 cents because as this is getting less likely to be in the money, of course, the open market of options is going to start pricing this differently. So yesterday, this went all the way up to 36 cents. And even when I opened it today, it wasn't 29. Like this is recent in the last couple hours. It has dropped back down from 36 to 29. And that's, of course, because the market's down so much. The VXX is up a lot. It's getting further away here. So the market is pricing in that it's less likely to hit this profit range for us. The further away it goes over here, the lower the premium will get, right? It's going to be less and less advantageous. If it gets closer here, yeah, you might have to pay more, right? So it actually did drop a good 6 or 7 cents. That's significant. Now, 5%, this trade has 2 weeks to go. So it's not going to move a ton. Like we're on 14 days right now. These shorter dated contracts, everything is relative to the days to expiration. So it would take an awful lot to see major changes in one day. But 7 cents, that's a lot. And now it's 8 cents. It's down to 28. The further it goes over here, the further it's going to change. So yeah, I would say that it's probably just because you're not like me. You're not on your computer all day looking at these prices like I am. So I've seen it fluctuate anywhere from 28 to as high as 36 in the last one day. That's what it is. This is interesting. I'm the wrong person to ask, but can we use AI tools like ChatGPT to be better traders? I would say no, but you can certainly use ChatGPT to be a better entrepreneur. If you are in the business of investing, then yes, AI is going to be awesome for you. If you are doing the investing, I would say no. I would stay away from that. It's certainly years away from being helpful. It's one of those buzzwords these days. People like to say, I have a strategy that's based on AI, it's based on machine learning. Sounds really cool, but no, probably not. You can't trust these things yet. You want to stick to your own edge. But using ChatGPT to forward your business, yeah, absolutely, you can do that. All right. I went for ages there on that side rant, so I think I might have burned some time here. Let's do one more question because I can probably make this one into a clip and I can upload it. Sometimes the good questions, I do that. So, a lot of content about Iron Condors, but you refer less about calendars. Does the strategy use them less? Low volatility is more frequent than high, so you should use them more. So again, this is one of the things that it is in our Iron Condor course for the community, where we do talk about the difference between Iron Condors and calendars and when we would be taking these trades. So essentially it comes down to volatility. Like you referred to, low volatility would be better off. So we do use condors and calendars in the same strategy. Even though it's called the VTS Iron Condor, it is still using calendars about 33% of the time. So 2/3 of the time we're going to use Iron Condors. And how would you divide the market? Well, essentially, if you're a member of the VTS community, you will have access to the volatility barometer. I'm trying to find it here. You'll have access to the volatility barometer. And essentially what we do is above the 33% line, that would be a good crossover period to favor the Iron Condor because of course these are Vega negative trades. Iron Condors benefit from the volatility coming down. So remember, if we sell it for $1.25, we want the premium to come down to make our profit. So you want to sell Iron Condors during mid to high volatility. So it's a better starting point. If you sell it when it's really low and it's a Vega negative trade, there isn't much room for it to go lower. So you're actually walking into a potential headwind there. What you want to do is you want to sell Iron Condors during mid to high volatility. Calendars for low. So you might ask, well, how often is that really? You said low volatility happens most of the time. This is our volatility barometer. So I would agree with you that before the Volpocalypse event in 2018, I would agree with you that calendars were more frequently used because we were actually significant amounts of time below 33. But since Volpocalypse, you can see volatility hasn't really stayed low for very long. And we've not seen many instances below the 33 level. We've basically been mid to high for the last 4 or 5 years. So we have been favoring Iron Condors most of the time. But if you're doing a calendar option, like this one, for example, now this trade is essentially, because it's a long-dated trade, you can see this pink line is above zero. You can see right here it says at today's hash line, it says 1361. This is a Vega positive trade. So this debit of 224, to make our profit, we want it to go up. We want volatility to increase. So if you wanted volatility to increase, it makes sense to buy the calendar when volatility is low. That's a much better starting point. If you buy a calendar when volatility is really high, well, can't go much higher, can it? But it can drop lower really quickly, and that calendar can stop loss out really fast. Whereas if you take the Iron Condor, which is a different trade, you can see this is a negative number. This is a Vega negative trade. So that's the cutoff point. And if you are not a member of the VTS community, while the VIX index isn't great, I always try to shy away from it if possible. But if you only have access to the VIX, then you could also do the same thing. The 30th percentile on the VIX index is 1519. So below 1519, you'd use calendars, and above 1519, you'd use Iron Condors. So again, how often has that happened? Well, if you look at the VIX over the last, I think this is 5 years, 15, let me draw it on here. It's right here. This is the 15 line. So how many calendars should you have opened in the last 4 years? Or this is since COVID, so 3 years. None, right? It's entirely Iron Condors. Before that, sure, the VIX did go to the teens. It went in 2016, 2017, pretty much from March 2016 all the way to January 2018. The VIX was in the 9s, 10s, 11s. So you could have done a lot of calendars back then. But in the last 4 years, no, we just have not seen volatility levels to justify those calendars. So I've been pretty heavy on Iron Condors the last several years. It just is what it is. But long term, stretched out 10, 15, 20 years, yeah, it's about 1/3, 2/3. 1/3, you go for the Vega positive calendar because it is a little bit more beneficial when volatility is low. If the VIX is 12, go for the calendar. 66% of the time, we're going to go with those Iron Condors because mid to high volatility, it's probably going to decline and you can make your money quicker that way. So yeah, that's how we divide it up. And I have no preference to either. They're both delta neutral. They're both great trades. It's just typically Iron Condors are the default just because it could be several years before we really move to a new low volatility regime. We just don't know when that's going to happen. You don't want to set yourself up for a headwind by selecting the wrong trade structure. Remember, it's not a strategy. An Iron Condor is not a strategy. That's just a trade structure. The strategy is how to allocate the capital, how to enter, how to exit, what's the risk management plan, all of these things, what expiration cycles, how wide are the wings, how big are the strike gaps. That's the strategy. The structure itself is just calendar versus condor. It's just a simple question of volatility. So we have been going for 2 hours. That's bad. I'm supposed to stick to an hour. I was ranting about performance, and the last thing I'll say on this whole performance thing for anybody who is still milling around here is that I truly hope you are one of those people, one of those very rare people that is a standout trader. You just have to understand that I've been doing this for 17 years now. I started investing when I retired from golf in 2005. And in 17 years, the number of times that I have seen an impressive track record that I thought, wow, that's amazing, and have it actually stay is, I guess zero. Maybe I'm forgetting something, but it's pretty close to zero. I've been on Twitter for a number of years. The number of people that I have seen that are saying with words on Twitter that they make X rate of return, only to realize that they don't make any money off that expertise. So obviously it's not true. Like if you're a good surgeon and you make no money as a surgeon, I don't believe you. I don't believe you know how to operate on a heart if you don't get paid to operate on hearts. That's seems logical to me, right? So you got to understand that all of these opinions that I have are based on 17 years of seeing people have 1 good year, 2 good years, and just have it fizzle out and die really quickly. These subscription services that launch over and over again, promising massive returns. You go back 6 months later, the infighting between the community is off the charts because there's a massive disconnect between what that subscription guy said that he returns before he launched the subscription versus what the clients who are actually paying money get after they start paying money. That disconnect, you're fooling yourself, not you again, the proverbial you. They're fooling themselves if they think that people are just going to pay money and be quiet about it. They're just going to be like, okay, he's a big liar. He said 100%, I made 7. Water under the bridge. You're fooling yourself. That person who you said you could make 100 and they only made 7, they're going straight to Twitter and they're going to insult you for it. So that's what ends up happening with all these. I've seen thousands come and go. Thousands. How many of them have lasted? All right. I should actually try to run the numbers, try to experiment. How many subscription services do I know that launched around the same time as mine and are still here? I don't know. I would venture a guess you could count them on one hand, if that at all. I'm not actually aware of any. There weren't many when I launched. I was maybe the first or one. Oh, no, that's not true. Bill Luby had one significantly before me. He had his short volatility one before me. I'd like to say his launched in about 2009 or 10. And he's an awesome follow, by the way, just now that I've mentioned his name. Follow Bill Luby, VIX and more. But he doesn't have the service. I don't think it's because of performance. I just think it's not the direction he went. But I honestly can't think of any. They don't last more than a year. They really don't, because People who are paying money, they really do expect you not to be a liar. Funny thing, right? They expect you to actually be accountable for what you were saying the whole time. You know, who knew? As soon as people start paying $100 a month, they actually want you to be telling them the truth. And it just fizzles out and dies really quickly. So I'm cynical and skeptical, but it's based on, you know, nearly 2 decades of experience watching this cycle play out over and over and over again. Person says he's amazing. 2 years later, he finds out it was just shit beta. It's not alpha, it's just shit beta. They just levered up and they just happened to catch a really good advantageous market. They made a bunch of money, and the market has a way of evening things out. Just like Las Vegas has a way of, if you go in and you make money at roulette, you don't have a system, you're not beating the casino, it's just levered shit beta, and you caught a nice little 2-week run, but it'll end. It'll end. So I genuinely hope that there's a few people in our community, or just people I don't even know, just people out there. I'm always cheering for people to succeed in this world. I'm never negative. I never tear anybody down. I never criticize anybody else's business. Never, you know, I cheer for people. I think it's great. But you have to remember, I've seen very, very few that have staying power. So I can tend to be a little bit skeptical and perhaps even cynical. It's for good reason. And look, if you think I'm wrong, like, use me as a counter to what you already think. There's some people that buy my subscription and pay me money that don't actually take all the trades. They just know that I'm a conservative investor and I'm very careful not to be in the wrong positions at the wrong time. So if they see me doing something like moving to safety, for example, doesn't necessarily mean they have to as well. It's just sometimes nice to have somebody who's conservative, who you can bounce ideas off of. So if you're out there and you're trying to make 50% a year, and I'm here telling you that 15% a year is world-class, okay, let's find some middle ground and let's make sure that you succeed a little longer. Maybe just use me as that. Devil's advocate, your friendly neighborhood devil's advocate. I'm good at that because I do actually require evidence to believe in things. So if I haven't seen any, it's probably just a 280 character tweet that somebody put out. You shouldn't believe everything. Anyway, I've ranted way too much about that. Let's wrap it up here. We will come back next week. I'll try to keep the first hour super rant free, and then you can let me go off the rails after that. I should probably be drinking wine right now because I ranted a lot. I went way off course today. But thanks, everybody. I will see you next week.